Investors, hello. This is Stock AI Insights Earnings Analysis, and I'm your Chief AI Analyst. Just a reminder, this is for educational reference only and is not investment advice. As you know, investing involves risk. Today, we are parsing Beta Technologies' Q3 2025 earnings, which dropped on December 4th. And what a pivotal quarter this was, coming right on the heels of their November IPO. And that quote from their founder and CEO, Kyle Clark, really says it all, doesn't it? A show, not tell business. That's the lens we're going to use for this analysis because it's all about matching their words to their actions and, of course, to the numbers. All right, here's our game plan for today. We'll start with a snapshot of the quarter, dive into revenue, then unpack the costs. After that, we'll look at their guidance, navigate the key risks, and wrap it all up with our final verdict. Okay, let's kick things off with the big picture. And believe me, Q3 wasn't just another quarter for Beta. It was packed with major strategic moves. You know, when you look at this list, it's clear they were busy. They went public on the NYSE, which is huge. They locked in a massive partnership with GE Aerospace, complete with a $300 million investment. They got a critical FAA certification for their propeller, a first of its kind. And on top of all that, their order backlog swelled to nearly 900 aircraft, worth a cool $3.5 billion. These aren't just small wins. These are foundational building blocks for the entire company. So, with all that momentum, how did it translate to the top line? Let's process the revenue numbers. For the third quarter, total revenue came in at a solid $8.9 million. And what's interesting here is that this number actually beat their own internal expectations. Now look at this chart. That's some serious growth. We're talking about revenue that's nearly tripled compared to the same time last year. And when we break it down, it's coming from two key areas. About $2.9 million from product sales. They delivered some motors ahead of schedule. And another $6 million in service revenue thanks to their defense contracts. It's really encouraging to see them building out multiple income streams this early in the game. But hey, strong revenue is only half the picture, right? Pioneering a whole new type of aviation doesn't come cheap. So let's look under the hood at the costs. Okay, so the headline number is a net loss of $451.8 million. I know that looks like a huge number, but it is absolutely critical we dissect this because it's not what it seems. Here's the key. The vast majority of that loss, over 78% of it, is a one-time non-cash accounting charge. This has to do with how they valued preferred stock before the IPO. The takeaway? It's a paper loss, not operational cash going out the door. So if we want to see where the real cash is going, we look at operating expenses. Total for the quarter was about $87 million. And look at this. Almost two-thirds of that, $56.4 million, was poured directly into research and development. This is the fuel for their entire certification and production engine. And that R&D spending isn't just random. It's tied to this incredibly smart strategy. I love this metaphor. Think of it as building a ladder to the sky. They didn't try to leap to the top. First, they got the propellers certified. That's a solid first rung. Now they're focused on the electric engine. Each piece they get certified makes the next step and the final climb to a fully certified aircraft that much safer and more predictable. Okay, that's where they've been. Now, where are they going? Let's process the company's own flight plan for the rest of the year. Look at this table. For the full year, they're guiding for revenue between $29 and $33 million. At the same time, they're projecting an adjusted EBITDA loss of around $300 million. What this tells us loud and clear is that the strategy continues. Invest, invest, invest. They are prioritizing growth, R&D, and getting their aircraft certified over any kind of short-term profit. Now the flight plan is clear, but as with any journey into new territory, there's always the chance of some turbulence. Let's talk about the risks. And this isn't just speculation on our part. This question takes us straight to the risks that Beta themselves have laid out in their official SEC filings. This is what they are telling investors to keep a close eye on. We can really boil these down into three main buckets. First, you've got execution risk. Can they actually build these things at scale and get through the entire FAA gauntlet? Second, there's market risk. What about the competition? And will they be able to raise more money down the line? And third, operational risk. They rely on key suppliers, and while this is aviation, safety is everything. So, after processing all that data, what's the crucial takeaway? What's the bottom line from this quarter? Verdict? Beta is doing what they said they would do. They're hitting milestones, growing revenue, and locking in key partnerships. But the path to actually being profitable is still a long one. And it's paved with really heavy but absolutely necessary investment in that step-by-step certification ladder. It's a long-term play, plain and simple. What are your thoughts? Drop them in the comments below. We'll see you next time.